Hello everyone. My name is Vikas Agrawal and I'm the founder of AIF and PMS Experts India. So, at AIF and PMS Experts India, we keep organizing these knowledge-based sessions and we call it Ask the Expert Show, wherein we invite industry experts and talk to them, read their minds and understand what's happening in and around the world, and also follow the same philosophy what they follow to create wealth for themselves. So with me I have Kanika Agarrwal. Kanika brings about more than 18 years of rich experience when it comes to investing in equity markets both in India and internationally. She's a chartered accountant with 18th rank. For us, it's only a dream, to think in those lines. So she's a rank holder, chartered accountant. She's also completed her CFA. She's BCom from Mumbai University. And she was very passionate about equity investing. So we thought we'll invite her today and try and read her mind. So she's got a good amount of experience in this area. Apart from that, she loves traveling across the globe. So let me first ask first question, that which are the countries that you've already traveled and you feel like traveling?
Right. Hi Vikas. Hi everybody at AIF PMS. Thank you for having me. Very excited to be here. Traveling. Last few years have been tough. None of us have been able to travel, but the nicest location I've been to is Iceland. That landscape is nothing like anything there. You'll be able to see volcanoes, glaciers. So the best location I've traveled to so far is Iceland. You get to see crazy amounts of landscape there. They have black sand beaches, volcanoes, glaciers. It's hot springs, all sorts of different experiences you can have within one small island. So it was a 10-day trip. We did the entire island. We saw whales. It was beautiful.
Yeah.
So would highly recommend that. But other than that, we've done lots of Europe, lots of America, lots of Asia. So
great.
Lots of traveling for sure.
Sure, great to know that. You're the founder of Upside AI. So let me begin by asking you my first question. So what made you to start this company, A? And please talk to us about your team.
Sure. So Upside AI was started by me along with two of my co-founders, Atanu and Nikhil. You kindly introduced me. I'll talk about the other two. Both Nikhil and Atanu are from IT Bombay. So I'm one CA and I'm stuck with two engineers building this. So Nikhil has a BTech and a PhD in computer science from IT Bombay. Upside AI is a shop where we use machines and rules to invest. So he writes all of our code.
I see.
He's worked with Microsoft, IBM on a bunch of different machine learning projects. In fact, his PhD thesis is being used by the Maharashtra government to decide drinking water distribution in the state right now.
Oh, I see. Okay.
Yeah. So,
wonderful.
So that's Nikhil. Atanu, again, IT Bombay, Credit Suisse. And then he went to New York to work on Wall Street for about 8 years or so, working with a $1 billion fund. There they were doing a multi-strategy. So VC, public market investing. They did SPACs also. So lots of different type of very varied US experience. And then he came back and we started this. What we're doing at Upside essentially is trying to teach machines how to do fundamental investing. Okay. So for us, we started by reading Intelligent Investor, Benjamin Graham, Warren Buffett, where we're all their disciples. But we felt like if Warren Buffett was starting today, if he was not 90, he was 18, he would use a lot more computers to make decisions, right? So that was our inspiration. And that's why at Upside AI, we try and combine fundamental investing, where we feed in company P&L, balance sheet, cash flow, GDP data, inflation, interest rate, all of that to try and understand in this market, what should you be buying? So that is really the ethos behind Upside AI.
Sure. So it's been what, 3 years now?
Yes, it's been 3 years. Yeah.
So can you talk to us your sort of experience that you've gained in last 3 years?
Sure.
How does the machine and human works? While this is the future clearly looks like, because human minds have few limitations.
Correct.
One, they cannot really do a large calculations. Obviously there are limitations.
Yes.
And then of course the human biases,
very important.
It could be anchor biases, it could be anything. So I became biased towards a stock which I bought 10 years back.
Correct.
And I don't want to sell it. So, talk to us about what was the reason and why did you feel, and can I also call this as a quant investing to a large extent, or how?
Yes, I think quant is a umbrella term. It covers all types of investing where you're using some sort of rules.
Okay.
I would say even an ETF is a quant product because the rule there is by the index, right? It's the most simple type.
Right.
Even an Excel filter is a quant product because you're using numbers to filter what you should buy. Right, and we are now the next generation where you're saying ki, there were static filters like your Excel filters or anything. Now you use machine learning to do more evolved thinking.
Sure.
But yes, we're all quant.
All
Absolutely.
right. So if I have to look at particularly when you say it's a good combination of machine and humans.
Yeah.
So can you throw more lights in detail that how do you define your investment philosophy and what are the parameters that you look at before selecting businesses in India?
Right. So, very important question. I think, and you talked about this, right? So far, when we think about quant, what we're thinking is technical investing, right? Someone doing momentum, charting. Lots of people use software to do it.
Yeah.
Or high frequency trading, right? Co-locating with servers, all of that, those
Right.
big hedge funds do. But that is not where any of us are going to park our money, right? We give money to human fund managers, jo stocks, they're reading fundamental balance sheets and figuring out what is a good stock to buy.
Right.
And you very rightly put the main problem with that is human biases, emotions, the love for a stock, the hate for a sector, and
Right.
of course how much you can compute, how many stocks you can track.
Yeah.
So that is the problem we wanted to solve. Okay, let's teach machines fundamental investing. So for us, what we're doing is right at the beginning, we will pull all fundamentals, P&L, balance sheet, cash flow, GDP, interest rate, inflation, yield, volatility, everything. Put it into the system, and the algo then converts every company into ratios and numbers that are common sense. There's no new number.
Okay.
हम क्या देखते हैं when we try and analyze a stock, हम देखेंगे growth numbers, return ratios, cash flow metrics, debt numbers, valuations, all normal stuff, right? But the main difference is here. At this point, any good screener even will say, "Acha, now let's put a screener, 20 P, 20% growth, 20 ROE, ऐसे कुछ, I'll get a short list of stocks on that, I'll do some work and then I'll buy another short list." For us, we said, why this magic 20 number? Why does it apply in every market? Markets are constantly changing. So learn what the right number is for this market. And that is really what the algo teaches itself, which is it goes back in time, many time periods, to understand what is the meaning of a good stock today. Let's take the example of Maruti, right? And this is not investment advice. Maruti, let's assume, is a good stock. Fundamentally, it's a good stock. But the market every year makes a different decision on Maruti. One year it's a good stock, one year it's not.
Correct.
So can you buy stocks at that intersection, which are not only fundamentally good, but market also thinks they're good? So I'll give you an example. We were live in March 2020 during the COVID crash. And that time when we ran the system, it said, hey, we're not sitting in cash, but what we are doing is buying these kind of stocks. Stocks that have no debt on their books, that have high ROEs, that are expensive in the market, but full market is cheap, so I'm not that sensitive to valuations. Export oriented companies, so हम chemicals खरीद रहे थे, lots of chemical stocks. Now cut to 9 months later, by December 2020 when you run it again, algo is saying something completely different. It's saying markets have run up a lot. I am now very averse to expensive companies.
I see.
I'm a value investor now. Look for cheap stocks. I don't mind debt on books. There has been no growth. Growth is not a parameter for me today. So we ended up investing in metals a lot in December 2020, and the first half of 21 we were primarily in metals.
Okay.
So a human
So you
can't
get a direction.
Correct. You get directions, you get trends, you try and understand what is good fundamentals today. And if a human came to you and said, fund manager कि मैं chemicals में बैठा था मार्च में, अब मैं दिसंबर में सब बेच के metals में बैठा हूँ, you would say you're mad, right? You can't make up your mind.
Yeah.
But machine does not love or hate anything. So it can ruthlessly say कि Atul was good in March, but by December JSW is much better. So it can make those kind of switches. So that is what we're trying to do, which is teach machines how to do that. And then of course we come in where we do corporate governance checks. Once the screener throws up things, we make sure that there is no garbage in, garbage out happening.
Yeah.
Then we buy things.
Sure.
And then we buy and hold. So
Yeah.
we hold for one year our stocks.
Okay. So before we move on to the product lines, especially the US investing,
Yeah.
the last question is, so how would your machine get to know what is going on in promoter's mind?
Right.
It could be either side.
Yes.
How would your machine get to know? We talked about Maruti, and Maruti is just an example. it's a disclaimer that we are not recommending any of these stocks to buy and sell. So when you talk about Maruti, how would the system get to know that Maruti has now order book or the expected order book which looks to be extremely good?
Correct.
So how do you handle that problem?
Correct. So 2-3 things, right? Let's extend this even more. Into our system, we are not putting any forward-looking estimates. We don't look at the future. There is no qualitative things like management quality. None of that is built in.
Agreed.
So when we're doing that, will I miss the next Google in India? 100% I will. Right? I can't catch anything that is very early. But I'm not trying to do that. What is my mandate from my investors? It is, can you buy a stock, a portfolio of about 15-20 stocks, which are good companies that deliver me the targeted return you are saying you will deliver. Bas, that's all I have to do. There are so many ways to make money on the market, you cannot capture them all, right? You can make money in IPOs, you can make money in PSUs, you can do special situations. We don't do any of that, right? We're just trying to consistently try and pick good companies. So now what goes on in a management mind, let's convert that into management quality. What we have found is it shows up somewhere, management quality. Either it will show up in actual fundamentals, how they are performing, or it will show up in valuations, what the market perceives of the management. And you will see this, right? Generally in any sector, companies that trade at a discount to their peers do that because either management quality is suspect or corporate governance is an issue, or they are, some version of poorly managed or poor product lines. So market is much smarter than we give it credit for, right? So I don't have to say ye management ne ye socha. Usko already pata hai because market has given it those signals. So a lot more is captured in numbers than we would like to think already.
Sure. So now we want to talk about US investing particularly. So
right.
I think you're advising few clients.
Yes.
And so what we want to know is particularly one, is this the good time to enter into US markets? Because I'm not talking about Facebook, which has fallen down by 60%, but
yeah.
overall the index is down by 25%.
Correct.
And B, when you invest in US market sitting in India, how do you advise your clients to invest there?
Right. So, is this a good time to invest in the US? You talked about, right, 25% the S&P 500 has fallen. You look at the news cycle that's coming out of the US. The Fed is coming and telling you, hey, we're going to do some more hikes. We want there to be unemployment. They are not going to see inflation come down for another 2 years. Every single worst case scenario you can think of, the market knows at the moment, right? Fed could not have given you worst commentary the last time. If you are the most scared, that is when you should be investing, right?
Well said.
Correct, because this is your highest point of fear. So in general, highest point of fear is when you should go into a market.
Yeah.
So if you're worried about US recession, all of that, I'm not even saying that may not happen. But the whole point is, if you think you've found a nice entry point, you can't predict the next year. Can you predict the next 5 years? And I think that the US is, up and to the right over the next 5 years. I don't know what will happen in the next year.
Sure.
So we are extremely aggressive about the US market. I think it's a great time to be coming in. Generally, having said that, even when clients, want to invest with us, what we advise is a staggered approach, where say someone gives us 100 rupees, we will invest over 3-4 months. Money comes and then we'll say, okay, now park 33 rupees this month, 33 rupees this month, so that they're able to come in at different market levels. But short answer to your question is, if you're scared to go into the US market today, you should go in today for sure. That is how we look at it.
Yeah.
Right? And second part of your question was really the kind of things we are advising on.
Yeah, at your investment committee level.
Yeah.
What all things that you look at investing and how do you do that?
Right. So what we saw, right, and you talked about the S&P 500 has also fallen 25%. The problem with indices is the same as it is in India, which is it is very top heavy. The top 10 companies, even in the US in the 500, account for 30% of full market cap.
Correct.
And most of them are tech stocks.
Yeah.
So now 10 companies, all tech stocks are 30% of the index. So even when you're buying the index, you're still buying tech, and that's why you're falling 25%.
Right.
So when we started looking at how to advise in the US, we said, hey, the US is so much more than just technology, right? It has the largest consumer brands in the world. It has the largest healthcare sector in the world.
Yeah.
Its healthcare sector is bigger than India's GDP. That's how big it is, right? Biggest telecom companies, utility companies. There is so much breadth and depth can you try and invest in America and not just in technology? That is how we started thinking
So
about
it's no
what
more
to pick.
US alone, it's global markets too.
Absolutely. It is also a gateway into the world. If you want to invest in China, अब आप China में जाके demat account नहीं खोल सकते, right? But you can buy a China ETF from the US, right? You get great access to lots of different geographies also from there.
Across the globe.
Across the globe. So that was really our thinking, which is use the US as your gateway into much broader diversified investing. And that's how we have been advising clients. So when we were looking at the US markets, we said, okay, how do you be diversified? What do you do? So we divided it into 3 buckets. We said, let's look at US equities. Large caps एक bucket है, which is S&P 500.
Right.
There is US mid and small caps, which Indians have no idea how to play, right? And then there is emerging themes.
Sure.
The future, right? How do you decide what to invest in the future?
These are small caps of them.
So yeah, these are the
in their language.
वहाँ पे small caps are $2 billion. That's the smallest small cap,
Sure.
right?
I know.
So for us, 12,000,
Yeah.
वो कितना हो गया? That's 16,000 crore market cap,
Almost,
right?
yeah.
That's huge for us.
Yeah.
So
Almost 8 times more.
Exactly. So that was our thinking. So what we did is in the large cap bucket, the S&P 500, which is those stocks, they break out into 11 sectors, which is technology, real estate, utilities, telecom, blah blah blah, bunch of them, and each of them has a frontline ETF, which is run by a Vanguard, a BlackRock, hundreds of millions of dollars.
Yeah.
So what we said is, can you figure out which sector you should be in today?
Okay.
Because maybe the last 9 months you should not have been in technology. Can you figure that out by reading macros? So that is what the system is doing. It is trying to read US macros, वहाँ की GDP, वहाँ की Fed commentary, interest rates, inflation, and understand what sectors are good to play today. And basis that will tell you, okay, today I think you should be in real estate, materials, utilities, not at all in technology. And basis that we'll just buy those ETFs of that. So that's how you play large caps. Understand the good sector to be in. On mid and small caps, we actually go bottom up. Mid and small caps are like you're looking for hidden treasure, right? Those are stocks that are either undervalued or stocks where a lot of innovation happens that are then acquired by larger companies. In the US, M&A market is very, very active. So lots of small and mid caps end up getting acquired. So we said, let's read P&L, balance sheet, cash flow data and understand what is a $100 stock available for $80 for me.
Okay.
And build portfolios of 10 mid and small cap stocks to buy. So that again the machine is doing where it's teaching itself. Just like our India algos run, same thing happens in the US where it runs to understand that. And the third part of it is actually trying to play emerging trends. We keep talking, I'll give you an example, EVs. We've decided that EVs are the future. Sometime in the future, EVs are what will... But how do you play it? Tesla, kharido, right? Look at the valuations. Does that make any sense? And do you even know if Tesla will be the winner? So how we thought about playing that is, can you actually figure out how to play lithium? Right? Lithium goes into all batteries. It is your primary technology at the moment. There is a lithium supply chain. There are miners of lithium, right? There are battery makers. There are EV makers. So can you buy companies across the supply chain and invest in lithium because you're able to get access to EVs at much cheaper multiples. Similarly, can you buy genomics? Genomics is the next trend in healthcare. All of our RNA COVID vaccines came out of genomics. And they have been beaten down so much. Genomic companies are trading at cash, 1 times cash on books.
Okay.
So very, very cheap at the moment, right? So can you play those kind of bets where you're able to take 10-year bets, where you find a sector, you find a space, you find a company and then just buy and hold. Right?
But how do you do that? Like you invest in these stocks directly there or through ETFs?
Both. It's a combination of stocks and ETFs. And because Atanu, my third co-founder, has been in the US for so many years and he's been on Wall Street, he has a lot of US expertise to be able to make those kind of calls. He's managed money for family offices, pension funds, so he understands risk management, he understands portfolio building in the US, and that's really why the kind of advice you want to give is more composite, where you're able to take sector exposure, stock exposure and forward looking buy into the future. And that is the kind of things we want to offer in the US.
Okay.
Yeah.
So basically it's got to be a bunch of both direct equities and then ETFs also.
Absolutely.
Okay.
So you build a basket of 10 to 20 stock plus ETFs and then that is what you offer.
Sure. Let me ask you the percentage also. So you talked about 3 different themes. So
right.
what percentage it will be in the emerging, what percent it will be in the mid or small cap or maybe large cap?
Right. So this again is advice that we give. So it's non-discretionary, and therefore
And it keeps changing depending upon
it keeps changing. For us, currently, how we're advising is to park half the money in large cap ETFs, put 30% in mid and small caps, and 20% into emerging trends. But again, clients follow whatever makes most sense for them to do, because it is just advice. But broadly, and even our advice can change as markets change, of course.
So let me put it this way. So I'm your client, for example, and let's say I want to give mandate to you.
Yeah.
Mandate as in I look forward for your advisory for investing in US markets.
Right.
Okay.
Right.
First of all, in India, there are very limited number of players who understand US markets per se.
Yes.
So obviously, you are the expert in this area.
Sure.
And you're co-founder as well.
Correct.
So when you look at US, so obviously then you will have a discussion with me.
Correct.
In terms of what's
Correct.
my risk appetite, etc.
Correct.
And when I am onboarding client, I am going to have a discussion with my client.
Correct.
After understanding it, then we're going to customize the portfolio.
Correct. So
right?
so it is a mix of that, absolutely.
Sure.
So broadly it is not just the US, it is also in India, because we are portfolio managers, we are first, our fiduciary duty is to you. Many times, clients will come to us, even in India, and say, okay, I have exactly 50 lakhs to invest, I want to put it in your PMS.
Sure.
We don't take that money, because we don't think that if you have only 50 lakhs and our PMS minimum is 50 lakhs, then you should give all of it to one person. Right? So we have refused money, because if your reputation is everything, if you can't sit here to gather checks. So you're absolutely right. In general, any advice we give you is based on what is best for you. If the US is not even good for you, we'll tell you don't invest in the US at all.
So last question before we conclude the session. We saw almost a decade US doing 18% at the index level.
Yeah.
And then thanks to the depreciation in rupee, it's only added up.
Absolutely.
And when I look at some of the mutual funds essentially invest in US market like Motilal Oswal, Nasdaq 100, they all have almost a decade of track record of delivering close to 30% and above.
Right.
And it's a decade story. It was not a story of a year or two.
Right.
As a portfolio manager of India, do you see the same trend emerging in US for the next decade also?
Where we will end up doing 18-20% annual, whatever, like
17,
supersized,
18 or maybe say 15 is the realistic number.
Yeah. I think pockets of the market, yes. It is the much longer term trend of the US markets. If you go back to 2000 and then look at it, S&P 500 has done about 7-8% annualized return.
Okay.
Right?
From 2000 to?
From 2000 to 22.
Okay.
Right? So for these 22 years, it's been about 7-8% return with dividends. So that is your reasonable trend of what you should expect. 15% is what we also target in the US markets. The way we target that is being able to actively manage what is happening. If you're going to invest in the index, having a 15-18% expectation is unrealistic.
Looks to be overestimated.
Yes, in general. Even when you invest in India and you say, okay, I'm going to buy an ETF and I expect a 15-18%, it is unrealistic.
Sure.
Nifty has done 12-13%. So that is what you have to expect. Right? But if you pick the right guys, if you pick the right sectors, you pick the right pockets to be in, of course, it is doable.
Now, why I was asking you is because if you look at market cap to GDP, that's one ratio, and that's US markets. Even today, after getting down by 25%, the valuation looks to be on a higher end.
Correct.
Hence, I was asking that you think it is sustainable?
A bunch of, look, it's like, are we going to go through some pain as interest rate environment changes, right? Absolutely. So over the next few years, there will be lots of teething trouble. We don't even know what the problems are. There is going to be 1-2 blow-ups, right? As
that is a journey, obviously.
Correct. Because right now you don't know which. Now we're hearing about Credit Suisse, but you don't know where the Lehman moments are in the US. There is a lot of leverage, right? There is a lot of junk debt. So a bunch of stuff will happen. There will be some versions of 2008, hopefully smaller blow-ups, but they will happen. And that is why I say that a 7-8% is the right number to think of, because you have to think of longer trends. There is no reasonable expectation of 15%, etc.
Sure.
I understand what you're saying about market cap to GDP, but it's only one ratio. You have to see it in the larger context of how much bigger the economy has gotten, how much more, are we more decoupled, less decoupled. The number of moving parts are so much that one ratio almost gives us no information anymore to make that decision, right? All you can look at is say, what are my trends over very, very long periods of time, and then assume that that is your trend going forward.
Sure. All right, so we truly enjoyed having conversation with you, and we really got to learn a lot about US investing.
Thank you.
And if anybody really wants to look at US, I think I strongly suggest that you should have at least 5% of your exposure to other markets. And why US makes sense is, as she rightly said, that US is no more a US market, it's a global market where you get an access to the entire world. Just to give you example, you look at Facebook or you look at Apple, you need to also look at where their revenues where is their revenue coming from. I mean, India contributes more than 50% of their revenue. So obviously you need to look at global markets, and you should have some amount of exposure in international markets. If you wish to know more about that, please speak to our experts. We have a dedicated team and relationship manager. They will reach out to you, or you can reach out to Kanika directly and have a word with her. Thank you.
Yeah, thanks.